thank you very much, Ryan, and good evening, everybody. And thank you for staying on and listening to my overview of Monks. I'm looking to try and give you a bit of a flavour for what Monks does, really what it's looking to achieve, and really where we see the opportunities moving forward for the Trust. So by way of introduction, my name is Jon Henry. I'm a specialist and director at Baillie Gifford, and I work closely with the managers of Monks and look after most elements of the Trust for Baillie Gifford. So in terms of Monks itself, best place to start is what's it all about? It's firmly about long-term capital growth. So savers looking not to grow income, but to grow their capital over long periods. And we invest in around 120 holdings, most of which are listed equities, with a modest allocation to unlisted or private companies, some of which we believe are the most exciting in the world. There's a modest level of gearing, and as I say, we have the latitude to invest in anywhere across the world. Now, Monks is flexible, so we have 3 different growth types. So the breadth of growth that we're able to embrace within the portfolio means that we can lean into or tilt the portfolio towards certain types of growth depending on the environment. We are well plugged into and resourced at Baillie Gifford and plugged into all the different regional equity teams and able to take some of the best ideas from right across the firm and incorporate those within the portfolio. And then finally, we're low cost. So that's a really important point. We're low cost at around 40 basis points per annum. And that's come down from about 58 basis points since the Global Alpha team took over managing the portfolio back in 2015. And that's the next slide I wanted to touch on, was just the team that looks after Monks. And I won't say a lot on this, but the managers are Spencer Adair and Malcolm McCall, both of whom are partners at Baillie Gifford, and they've been managing the underlying Global Alpha strategy upon which Monks is based for 18 years. So they're experienced and they're supported with a dedicated research analyst team. And then, as I mentioned earlier, they're plugged into the individual regional equity teams at Baillie Gifford. So we're really able to harness the best ideas that our firm can generate. In terms of the philosophy and what we're setting out to achieve, I think it's important that we just distill that down into the 3 key things as we see it. The first is that it's all about sustainable long-term compounding in earnings growth. That is ultimately what we think will drive returns of share prices and ultimately for shareholders in Monks. So we're looking to invest in companies that can exploit durable competitive advantages over long periods of time. The second is focus, and that is to say that it's really the few that matter. A vast majority of companies in equity markets over very long periods actually destroy value. So this portfolio is very much active in nature, so the active share measure is just shy of 90%, which means that we're very different to the index, and we're actively selecting companies. And we're really looking to try and invest in some of the most exceptional growth companies from right around the world. And the third and final one is task. And what that is referring to is the need as long-term bottom-up investors to be patient and to allow management teams the time to implement corporate strategies which can deliver growth. That means challenging companies in terms of their E, S, and G credentials, but also supporting them through difficult times, like we're experiencing at the moment. But ultimately, we think by doing that and being patient long-term investors, we're more likely to be able to generate attractive returns for shareholders in Monks. Now, I mentioned earlier the different growth types that we have in the portfolio and the different breadth of growth that we embrace. And this is what the next slide shows. The 3 different growth profiles that we have. Now that is really recognition of the fact that we recognize that businesses grow in different ways, and we want to embrace that. So we have growth stalwarts on the left-hand side of the slide there. We have rapid growth companies and cyclical growth companies. And before touching on those individually, what this allows us to do is move between different growth profiles gradually over time depending on the environment. So we've successfully done that in the past with this strategy. So for example, after the global financial crisis, we were initially in growth stalwart businesses, which held up very well. And we were then able to move into cyclical growth businesses as an economic recovery began. And today, we're in a similar position in the portfolio, with more of the portfolio in growth stalwarts, perhaps with some of the opportunities that we're seeing, with some very attractively priced cyclical opportunities, which I'll touch on later. But the important point here is that we're looking for a good spread across the different growth profiles. And just to canter through them quickly, growth stalwarts are the companies. These are steady, large companies that can compound earnings at 10 to 15% per annum, and are pretty good at weathering different economic environments. Rapid growth companies are very different in nature, growing their top line very quickly and investing heavily for growth. They are the companies that have been most sharply hit by recent share price falls. And then there's cyclical growth companies. These are companies where the capital allocation skills of management are absolutely key. We really think that in this type of business, it's all about when you allocate capital and their ability to do so in a consistent manner at levels that can generate attractive returns. So the next slide touches on the portfolio itself. Now, there's rather a lot on here, and it just shows you all the names we invest in, some of the recent trading activity highlighted. You can see the weightings in the different growth profiles as they stand today. So we're 37% in growth stalwarts, 33% in rapid growth, and nearly 30% in cyclical growth opportunities. And that's also split by holding size down the left-hand side. The structure of the portfolio is such that we hold a large number of names in smaller size, and we hold the names upon which we have the most conviction in larger size. But importantly, those smaller names, they're really allowing us to embrace the asymmetries of equity investing. So we accept that some of these companies, that the range of outcomes is wide. But if some of those companies are able to go on and generate multiple fold returns for the portfolio, the portfolio as a whole will benefit on account of having been able to invest initially in small size. So you can see some of the names in there. One or two have been touched upon actually in some of the other earlier presentations that you've heard this evening. Microsoft, for example, under growth stalwarts, is a fantastic business. I think Ben from Polar Capital mentioned that they're increasingly relevant in the AI sphere, but they have tremendous earnings capability in their enterprise software and cloud computing business. Also under stalwarts, we've got MasterCard. Really, the rails of digital payments globally continues to be a very strong business and churns out attractive levels of earnings growth despite the changing economic environment. In the rapid growth of a large number of really exciting names, many companies that are investing heavily today to become winners of the future. Examples I would highlight here include Alnylam Pharmaceuticals, which specializes in gene sequencing and gene silencing to treat disease. And we've also got the Trade Desk as another example of a programmatic advertising business. So we have a real diversity of business types within the portfolio. And then thirdly and finally, under cyclical growth businesses, are again a wide range of companies, but CRH would be an example of one, which is the Irish building materials and supply business with a significant exposure to the US market, roughly 80% of revenues coming from that market, but elsewhere TSMC in semiconductor manufacturing. So what you can see is that we have a healthy spread across different types of growth, but importantly within that, there's a great deal of diversification as we're able to take advantage of a really broad spread of opportunities. Now, just to touch on performance, what this slide shows you is the performance of Monks over the last 12 months, but also since the 31st of March 2015, which is when the Global Alpha team took over the fund. And I think the point here to make is that Monks has firmly managed to generate long-term returns. And since the team has took over in 2015, performance has been strong. The last 12 months have been more challenging, as we've seen somewhat of a perfect storm for growth investors like ourselves. in terms of the increase in inflation and the subsequent rising rates that we've seen, which are perceived to be bad for growth businesses. I think the point I would make is that whilst we've felt some pain in the portfolio, particularly in the rapid growth part of the portfolio, which is where the companies that are maybe the earnings and profit growth is a little further out. They're the companies that the market has been most downbeat on. But the point I would make in relation to the Monks portfolio is that by and large, those holdings continue to perform pretty well operationally, and that's what underpins our confidence in the existing portfolio. I think that the next slide is bringing us back to that point about earnings growth within the portfolio. Now this chart shows you the relationship between share price appreciation and fundamental earnings growth. The blue chart is the quintiles, the blue bars, I should say, show you the quintiles of earnings growth, and the line shows you the relationship between that and share price appreciation. And what it shows is that the companies that are able to deliver in the top quintile of earnings growth are the companies that consistently, i.e. over 30 years, are consistently able to deliver share price appreciation. So what we're looking to do is own that top quintile of companies. So whilst near-term performance has been difficult for some of the reasons I alluded to, we're sticking to our guns and being long-term in our outlook and sticking with companies and investing in businesses that we think have superior earnings growth potential. So where are some of the opportunities that we're seeing today? Now, as I'm sure you're all aware, there's been significant volatility and weakness in equity markets globally over the past 12 to 16 months. And whilst that's been difficult, for the performance of Monks, it also offers a significant opportunity. So firstly, on the left, we think there's significant opportunities in cyclicals that are structurally underpinned by attractive growth drivers, but perhaps are facing near-term headwinds. So the valuations of those businesses look very attractive. So we've been looking at companies, particularly in the housing and housing-related sector, companies like Trex and Composite Decking. We've taken a position in Pool Corporation, which is swimming pool maintenance and manufacturing in the US. We've also taken a position in a company called Advanced Drainage Systems, which looks to benefit from the transition from cement to plastic drainage systems in the US. We believe that's likely to be a key player in that market. So there's a range of businesses in different areas, housing related or indeed semiconductors increasingly, where the near-term headwinds that are affecting the share prices, we don't think reflect the long-term growth potential of those businesses. So we're excited about the opportunities there. Elsewhere, disruptors on sale is really a nod to the fact that some of these technology-led internet businesses that have been most sharply hit in share price terms recently, we think that there's significant opportunities both within the portfolio by adding to positions and buying new ones on the basis that the underlying growth of these businesses is likely over a very long-term view to be very attractive. So we've added to positions in the portfolio in companies like Farfetch, which is online luxury goods business, and Coupang, which is a South Korean food delivery and grocery business. Both those companies, we think, are establishing themselves as key players in their markets. Elsewhere, we've taken new positions in Mercado Libre, the South American e-commerce business, and added to Amazon, which continues to entrench itself in an infrastructure-like manner in pretty much all aspects of our lives. Thirdly and finally, capital allocators with firepower really is reference to the fact that the cost of capital is rising, interest rates are rising. Therefore, companies with capital at hand and management teams with sensible capital allocation skills could lead to very attractive returns for shareholders in Monks if we can identify and hold those businesses at what we think is an increasingly attractive point in the performance cycle and valuation cycle for some of these companies. So, for example, we own Prosus, the technology business, holding business, which is listed in the Netherlands and has exposure to Tencent and a range of other exciting online businesses. But also looking elsewhere at companies like CRH, like I mentioned earlier, who are consolidating the market in the US in building supplies, or Exor, which we don't own, but is an investment holding company. It's an example of an opportunity that the management team has a good track record with a lot of capital available to spend. So we think there are opportunities right across the board, which is hugely exciting. And I think the way and the approach that Monks has really enables us to be pretty well placed to take advantage of some of these opportunities on a forward-looking basis. So finally, I'm conscious that everyone will likely want to head off and have some dinner, but I think what I'd like to do is point you to some further reading, which is our Monks research agenda, which is a helpful framework that we think sets out some of the most exciting opportunities as we see it over the next 12 to 18 months that we should focus our stock picking capabilities on. We think that opportunity set is broadening, and we think that Monks' approach, with its broad definition of growth and willingness to embrace different types of companies from right around the world, means that we're in a good place to take advantage of that and drive returns for shareholders in the future. So I'll stop there, and thank you all once again for listening, and hopefully that's been a quick whistle-stop tour of Monks, and you've learned a thing or two along the way. Thank you.